pretty much what 2018 looks like. I think you can kind of see like 4.5% somewhere in there on the tail end. But so bottom line, rates are starting to cruise up. We had a pretty good conversation about the Fed mandate. There's a lot of people in the room, and when you hear about inflation going up, inflation is kind of the number one enemy of interest rates. Lots of people track the CPI indicator as where inflation is, but if you really want to be glued into what the Fed looks at, it's actually the PCE. Their target for that indicator is 2%, and that's their mandate, right? They have basically a two-pronged job, and that is to get inflation to 2% and achieve full employment, right? And when they're there, that's kind of like the utopian spot for them, but nothing is ever static, so they're always moving the needle up and then moving the needle back. So as it stands right now, you've got PCEs at 1.8. That has been cruising up gradually in 2017, and is one of the reasons why the Fed had the confidence to start moving the funds rate from 3/4 to 1.5 over the past year. Interestingly enough, we're already at full employment, right? It's kind of a, there's a lot of debate that goes around the actual U3 and the indice that the Fed uses to actually track unemployment. The U3 only takes into account active people searching for jobs. You hear, I don't know if you've heard about, but there's the U6 rate, which is the entire employment force. But if somebody stops looking for a job after 6 months, or they've been looking for 6 months, they get taken off the list. And so if there's just they get employment or search fatigue and fall off, that naturally will drive the U3 rate down. The U6 rate is more at like 8%, and a lot of people argue that's a better indicator of where the true unemployment rate is. But as it relates to the mandate and giving the Fed the confidence to actually continue to raise rates, they can say, look, our mandate is for a U3 at 5 to 5.2. We're currently sitting at 4.1, so they have the okay to push the throttle. And again, this is probably why they got the throttle started in 2017. As far as if you go out and the analysts are projecting that you're going to have 2 Fed funds hikes in 2018. PIMCO, my buddy, feels they're going to have 3. He thinks that they're actually, and their big feeling about this whole 2-prong mandate is that there's actually 3 prongs. The third prong being basically financial activity, health of the economy, stock market, overall feel. So if the stock market is pushing forward, and you see what we've been seeing lately with stock prices and the S&P rise, that is they monitor that as well. And if that starts tipping one way or the other, they tend to move policy. As far as the future for the funds rate and where rates are going, I thought this was probably the most beneficial thing I got out of the conversation with him, is that the neutral rate for the economy is 2.7%, or the neutral funds rate is 2.7%, I should say. So when the economy reaches its leveling spot, the funds rate should be roughly 2.7, right? And so if we're sitting right now at 1.5, right, we've got a decent clip to go, especially with how close we are to the PCE metric as well as the employment metric. So I think that's why PIMCO feels there's going to be 3 hikes, because you've got, they've got to basically make up or get up to a full percentage point. So, and they think they'll probably be cruising up closer to 2.5 in 2019. That said, the terminal rate, right, he brought up in our conversation, which I had never heard of before, but that basically is where once they reach the terminal rate, that's when the current cycle, it tips the other direction. That's the max that the Fed, in most people's opinion, that the max they will actually raise rates towards before things start to slow down. So as we are embarking on this rising rate environment, Fed rate environment, I think in the back of your mind, my question is, well, how far do we have to go, right? Or how far can it go? And I think if we're sitting at 1.5, we're about halfway there. Typical cycles are 3 to 5 years, and you could argue that we're about 1.5 to 2 years into the current cycle. So that is, in terms of just pressure, and we sat for, I don't know, everybody in this room, we've been enjoying a 8-year flat rate environment, right? We trundled all the way down, started in 2008. And here we are, it's been a 10-year run from 5.5 down to 3 3/8, poked up to maybe 4 3/8, down back to 3.5, and now here we're cruising up into this, kind of back up to that 4.5, 4 3/8 range. So I think the difference here is that you actually have all facets of the economy, and that stuff was happening, and none of these indicators lined up like this for them to actually push rates higher, but we're now at a spot where that's happening. So I don't think we're going to get another long, deep dip in rates. Or neither does he. Like, my opinion doesn't really matter, but this guy knows what he's talking about. The other pressure on rates that we talked about that he brought up and doesn't get nearly as much press is the actual Fed balance sheet. So during the actual economic downturn, they kept dropping the Fed's rate, but they also started purchasing mortgage-backed securities and purchasing treasuries in chunks. The current Fed balance sheet is now 4.5 trillion. You can see that they've got 2.5 trillion of treasuries and 2 trillion of MBSs on the books. So in October of 2017, you probably heard some people talk about unwinding the balance sheet. And basically what that means is that as the MBSs and the treasuries are paying off on the balance sheet, the Fed isn't going to take that capital and reinvest it back into the treasuries and the MBSs. So it basically just goes away. So you essentially lose a buyer for that sale. So that money is coming out of that market, again, putting more pressure on rates as we kind of move through 2018. The target balance sheet for the Fed is 3 trillion. So again, you know, as we kind of with the same topic on how far we're going with how far will the Fed actually pull or push the rate lever high, or how high will they go, to the extent that we're talking about the balance sheet, their goal is 3 trillion, right? So you're talking about 1.5 trillion that they need to move. They're escalating the actual payoffs. Right now it's like 4 billion a month, but they're going to escalate it up to 20 billion. And there's going to be 30 billion of treasuries coming off, 20 billion of MBSs coming off when it's all said and done, until they actually get down to the 3 trillion. So again, all this just is information to kind of get some scope. One, I mean, we're in the mortgage banking business. I think it's good to understand some of the technicals behind the things that are going to influence rates. I also think that it's good to really look under the hood, because I mean, I'm one of the people that would love to be able to believe that we're, you know, just like, you know, 3 years ago, it was just like a head fake at 4.5 or 4.25, and it's not going to keep going up. But I think this time it feels like it's for real, and I think a lot of the economic factors that are pushing it from behind are legit. So we got to get ready for change, and that's a big reason, you know, why we're here, because, you know, we need to get together in a room, we need to brace ourselves for a different market, and we need to share with each other on what those best strategies are, how we're going to get through rates, you know, as rates move to 4, 4.5, 5, 5.5%, depending on where they end up. Lastly on this topic, the question I asked him, I said, well, what about like just, what other things can kind of come in outside of just the technical stuff that we had talked about that might influence rates in 2018? And he said, he brought up a few unknowns. So the European Central Bank and the Bank of Japan are still in a very easy monetary policy time right now. They haven't started tapering. His feeling is as soon as they start tapering, which they feel over there is going to be pretty soon because they are in this high growth, no inflation segment, that increase in interest rates in those two markets are going to draw more capital out of the U.S. And again, you guessed it, more pressure on rates going higher. The other big unknown we talked about was if there's a war. I wasn't aware that there's apparently a lot of turmoil in the Middle East over, I can't remember the two countries, but he basically said, quote unquote, if there's an oil war in the Middle East between two countries in the oil region, that could potentially push rates higher, just for what it's going to do through the inflation rates. And if there's a Pacific war with our friends in North Korea, then that will kind of upset the entire apple cart and rates will go back down. The little blips along the way, though, where you are going to get dips, are going to be will be from a stock market correction, right? I think that's half of the conversations.
It's coming.
Right. So, well, half the conversations that you're going to see on Bloomberg or CNBC is, you know, how much farther do we go up? How deep is the correction going to be? 10, 15, 20%. When that happens, we should get a move lower in rates just because that capital is going to go somewhere else and sit for a little bit. And it's either going to go in cash or it's going to go in bonds and MBSs. So the long-term projection of that kind of a lasting rate environment, that's probably like maybe a 3 to 6 month window, more like a 6 month window of a drop in rates before the other factors kind of keep ratcheting us up into the current cycle. So that was pretty much a summary of a 2-hour conversation I had with this guy. Hopefully there's some tidbits in there but that you can use, gives you some perspective on what we're up against, and if you need some inspiration to maybe change your game or get ready for what's coming, that should be it.